Okay, just 2 minutes about wealth first. I'm sure most of you all know us, but a thought for those who have not known much about our firm. Wealth First is promoted in 2000 as an independent investment advisory focused on treasury and wealth solutions. We advise and manage assets in excess of 8,000 crores across corporate offices, provident fund trusts, and HNIs, and of course, family offices. Our core team has been unchanged since inception. We are probably the senior management, eight of us have each got more than 30 to 35 years experience, making our firm probably the most experienced wealth management teams in the country. Our team strength is over 80 actually, and our past achievements include winning the prestigious CNBC TV 18 award for India's best investment advisor in the IFA segment. This is the senior management, all as you can see over 30 years experience, and each one of us have a say in every portfolio that we manage. So our value proposition is basically a dedicated team, experience, expertise, client focus, no conflicting model. We have no products of our own. We don't manufacture products. We have a composite asset coverage, and we work for the client and not the product. Our investment service areas are across all products. We provide ongoing research and portfolio reviews. Basically, the entire gambit of services. Why new age products? Like I mentioned earlier, generating alpha using traditional methods of
Haji,
investments have become
Haji बोलो. Haji,
passe. Indian
हाँ,
equity markets are involved and is still sticking to traditional way of
Haji,
investment, not yield
निकल.
desired results. In the
सर्दी
last 10
खांसी
years,
होता है.
in the last 10 years, global markets have integrated and cycles have become shorter, which increases the need for acting fast. Due to the continuous money being pumped by central banks globally, factors like liquidity have gathered deeper limits. This needs to be monitored regularly as it can decide short-term direction of the market. As you're all aware, it's liquidity that is driving this market big time. Given this background, it requires a lot of data crunching to arrive at a conclusion regarding the trends. The use of artificial intelligence is a must given the amount of data that is available. Globally, asset management companies are gradually emerging as products and only manufacturers with a low management fee. Alternate funds and passive funds account for 38% of the equity compared to 20% in 2005. The share of long only funds has come down. When I mean long only funds, these are the traditional plain vanilla mutual funds and PMSs. The share of these long only funds has come down from 60% to 33% during the same period globally. Quant funds account for 36% of institutional trading in the US compared to 18 in 2017. And the top five long short strategy funds in the US are quant based. The world is moving towards quant, and I don't see why we in India will lag behind. We see a lot of future for this over the next couple of years. Why quant based? The ability to analyze large quantum of data efficiently in a very short term and arrive at conclusions. Challenge and reassess traditional ways of investment and valuation, not confining to one style of investment, constantly evolving and adapting, combination of fundamental factors and artificial intelligence, Very less of human interference and emotion. It actually removes the fund manager's bias. Of course, there are risks attached to this: over dependence on machine learning, emergence of and different trends. However, this is the need of the hour. The three fund managers that we are showcasing, the first one, Sandeep Tandon of Quant Mutual Fund, 30 years of experience in capital markets and mutual funds. He's worked for various mutual funds and uh, financial services companies. Some of the big current CIOs from other have worked under him before. The next one would be Kanika Aggarwal and Nikhil Huda from Upside AI. This was founded by Kanika, Nikhil, and Atanu 3 years back. Nikhil has a PhD in computer science from IIT Mumbai on design. He's also worked with Credit Suisse in the algorithm trading team. While Kanika spent 4 years in Mayfield, India, managing assets of 1500 crores and investing in early stage technology companies. Lastly is Harjeet Singh of Stelios Global. He's been a serial entrepreneur in fintech, edtech, and capital markets, and a financial mathematician and alumni of Stanford University. He runs Stelios Asset Management, an investment manager established in India. All these three funds have been tried and tested by Wealth First Investing its own proprietary funds over the last year. And we strongly believe that this category has to have a presence in every portfolio going forward. Some of the key features, I'm sure the three of them will elaborate further. This is a contact sheet of Wealth First, um, Mumbai, at two centers. If you want, you can take a screenshot of this so that you can contact us or seek more information. I'd like to emphasize one more time that this entire presentation has been purely for information purposes and should not constitute as an advice from us. We thank you, and we'd like to introduce to you Sandeep Tandon of Quant Mutual Fund. He will make a short presentation of about 15 minutes and then address a Q&A. Sandeep, good morning and over to you.
Thanks, Premal. Good morning, everybody. So, as Premal rightly emphasized, how the data analytics or various terminology we use through machine learning or artificial intelligence is gaining momentum, okay, and how traditional long funds, globally has lost market share. Like today, if you really recollect, Fidelity used to be number one player, Fidelity, Tiro. So some of these large names don't figure in top 5, and maybe in next 2-3 years, they will not figure in top 10 names also in the global asset management companies. Okay? And which has been taken over by BlackRock or Vanguard and various products, which is new age product. Let me just share with a very brief presentation with you guys, really understand where we are coming from. So more from a quant perspective, though the firm name is definitely quant, but the way we represent quant is that we quantify everything. Okay, anything which impacts market is about quantification, and we also specialize a lot of work we do on the behavioral finance side. So we quantify the overall data points, including the sentiments. Okay, so when we talk about new age investment product, we have seen over period of time, the traditional tools and techniques are becoming ineffective the way global markets are interconnected and they're very dynamic. Okay, so let me give you a small example. Like as a house, from the research perspective, we have been talking about how 2018 till 2023 will be very volatile. Okay, when we talk about volatility for most of the asset classes, in that sense, the traditional tools of buy and hold strategy will not be effective. Okay, though we are completely style agnostic, but when we look from our data points through a predictive analytics model, we try to gauge what type of environment we are operating. And the moment we got a sense, this is the data points are endorsing, and that's the way we evolve the concept of dynamic style of money management. Okay, and this is part of how new age investments are shaping up. So we call it in a slightly different, we call it dynamic style of money management, because we all live in a very dynamic environment. And if we don't understand the larger macro perspective, if we don't understand what is changing and how dramatically is changing and how it affects market, that is something we attempt and try to quantify. Now, if you really look at, when we talk about dynamic style of money management, just hold on, let me enlarge it. Okay. So when we talk about dynamic style of money management, okay, we also want to emphasize how the importance of multi-dimensional research are coming into picture. And with the help of technology, or we talk about machine or artificial intelligence or machine learning processes, or some way behavior analysis, if you want to call about, it is all about the multi-dimensional approach which we are trying to combine, and that is really helping us generating the alpha traditional, as compared to traditional approaches. When we talk about valuation aspect, everybody look at pure fundamental data. Okay, we don't deny that fundamental data is not, it's not important. I think it's a base for us. Okay, but apart from valuation analytics, in the current context, the liquidity analytics is very, very vital. Okay, and it's not about the FI data which we see, which is a very narrow way of looking the SEBI number or the FI number. That is liquidity analytics. Liquidity analytics is much larger and deeper concept. Okay, and if we combine the liquidity analytics along with risk appetite, okay, and we refer risk appetite more not from a inverse of risk, it is a risk appetite which is a behavior data points which gives us a perspective how the sentiments are changing. Okay, risk appetite reflects good amount of conviction or courage, if you want to call it, conviction level. So we try to combine. So we talk about how we bring qualitative, quantitative, and behavior aspect. This is the way we talk about the valuation multidimensional approach. And this, all these things really help us in forming our framework called VLRT framework, where we give 1/3 weightage to the valuation analytic, which is traditionally cash flow based analytics we do. We do 1/3 weightage to the liquidity analytics, and 1/3 weightage is given to the risk appetite. And T is the time. Time is the combination of all other three analytics. If they all three analytics are endorsing one side, we take a call on that. But it's very important to understand a dynamic environment, though we talk about 1/3, but as things changes, we also change. So let me give you a small example. Okay. And one of the reasons why we have given extraordinary performance from the September 2020 bottom. So if you all recollect, this COVID drama happened, and then March 2023, we hit a lower circuit, and 24 market made a bottom. Okay, when we started looking at the data in the first week of April, when we trying to analyze the data, because a lot of macro data we collect in the first week of April because of monthly data, we spotted something very interesting. Okay, the fundamental aspect, if you ask me, it was too premature for anybody to take a call that the fundamentals have changed overnight. Though we all know, depending on the situation, it could have definitely have impact, but nothing got changed on immediate basis. But what got changed was very interesting. The risk appetite data for us, for if I have to look at global risk appetite and India risk appetite, we were nearly at 40 years low. And with the pandemic, liquidity anyway was on a higher side. With the pandemic there, all the central bank in a cohesive manner was pumping extraordinary liquidity. So when we try to combine these two data points, okay, so we were coming out from a low, from the risk appetite which declined significantly in the first week of 2nd April, started inching up. And we were talking about extraordinary liquidity, which is a lifetime high. So risk appetite lifetime low, liquidity lifetime high. And that was the very lethal combination for a bull run. Okay, if I have to look at in isolation, then it won't get any answers. Okay, so situation like this, valuation analytics weightage declined significantly. The weightage came initially for the risk appetite significantly, and over a period of the next few months, what got changed was the liquidity. As liquidity was driving the market, Mr. Premal rightly emphasized that our weightage in some point of time was for the liquidity parameter was as high as 90%. Okay, so this is the way we define dynamic waste flow managing, that we adjust our data point in such a manner. It is based on the environment which we are operating. We talk about a concept of adaptive asset allocation without getting into any mathematical aspect. Okay, I just want to showcase in a very simple language. Okay, now this is what, how well we try to balance our portfolio. So valuation analytics are equally important, but sometimes we have seen, like, people talk about the nothing got changed, but it was the risk appetite which declined. People were not willing to take any risk. The market was very good, and suddenly we have seen a tsunami of liquidity, and we change every week. So when we try to manage our portfolio, we try to balance in our framework. This was I was trying to explain you in a different manner. Now, in the market, we have seen, that people talk about whether investment is a science or arts. That's a debate which we keep on happening. But our belief is that this is the amalgamation of applied math, science, and arts, both. Because behavior finance is a very important tool which we look at, data point, which is some sort of arts, we want to call it. And it's not only about just science. We, as a student of applied math, we like to say that if we can combine all these three data points, then it becomes a really effective product. Okay, because Premal was talking about how we have to remove human biases. Human biases. This is exactly what we do at Quant. Okay, in the last 30 years, we have also made enough mistake. I have personally made enough mistake, and this is what we are trying to say, that we should not repeat the mistakes, and that is only possible when you do a really data analytic in such a manner that we have to learn lessons from our previous mistake. And this is something which we have learned, try to remove human biases. So we don't meet now the companies up to that extent. We don't meet promoters closely because you get biased on a lot of data points. So we rely a lot of things on the secondary market data instead of relying on the primary market data. That is something which we bring to the table. And let me show you one or two graphs, okay, before we come. So when we talk about a multi-dimensional approach, okay, we try to create a predictive analytics model. And what goes into predictive analytics is a lot of a proprietary knowledge. Okay, so our life start from risk perspective. We try to look at how the global risk appetite is there, which asset class, which region, if something is changing, how the liquidity is changing. Okay, so and then so it's a larger aspect. We look at the currency data, we look at the credit market data, then we talk about the commodities data, then fixed income, and then last is the equity market. So we look at much larger macro parameter, and then we try to showcase a lot of proprietary knowledge which we have built, because it is impossible for a human being to track so much data point on regular basis, or rather on live basis. So we automate these things because historically we are running a very large quantitative based team out here. We have a lot of programmer working for us. So we try to automate as much as possible. And that is something which is not possible without help of machine. Okay, so what emphasis is this, trying to showcase how to look beyond obvious. Okay, let me show you a few data points. So it's something will be more interesting. Let's talk about very recent top. Okay, which happened on 19 February 2021. So if you recollect, this is the perception data, or this is a perception indicator for Sensex. Okay, it has a lot of history. So in 2008, our greed parameter peaked out here on 8 January 2008. And what is very interesting, around 16th February 2021, our greed level was exactly similar what was there at 2008 level. Okay, and since then you have seen market has corrected to the tune of, right now it has improved a bit, but from the peak it has corrected 6 to 12%, and stock has corrected between 5 to 30%, that depending on the what sector of stocks which you're looking at. But what is very important to highlight, that we were able to spot this opportunity, that this is the way greed is speaking out, and how well we have balanced our portfolio. That top 30 names, and this is for Sensex, the top 30 names in this country are giving you some signs of a peakish characteristic where these markets are peaking out. Let me show you some more data. Okay, so I'm just trying to give you perspective. When we talk about sentiments, we talk about perception, how exactly it looks. So look at last year, what happened. Okay, somewhere in the month of January, 19 January 2020, market peaked out when we spotted this thing. So it has not even touched the previous greed. And that's the reason right from January 2020, we were trying to prune down our leverage-based economy stock. We pruned down banking in a big way. So with some data points, I'm showing you one or two of them. So it'll give you some perspective how we operate. It was giving you some sense that some sort of greed parameters were coming closer to that. And we all know what happened later on. Okay, let's look at the sentiment data. Okay, look at, we all know in India, Harjeet was the maniac phase. So this was the maniac phase of 1992. I'm giving you this is not a price chart in any manner. Okay, this is a sentiment data of Sensex. The way we can do it for any index, we can go to sectors and we can go even to company specific level. So we try to create a perception and sentiments data for individual stocks also. We have built now for nearly 500 stocks. So this was 1992 Harjeet top. 2008 euphoric top. This is the second largest spike in the sentiments data, and so is the case with Lehman crash, the lowest point in the history of sentiments, and so is the case in March 2020. So this becomes a benchmark whenever next level of peak, if I have to look at, if anything come closer to these levels, maybe this may be a manic phase, but anything comes even to this level, it gives you some indication this is getting a signs of picking out. Just like the way I've shown you from the perception point of view, but sentiments have not spiked up to that extent. Okay. So look at just what more data points in US, because we have maximum concern in US. Look at some of the data points, our behavior indicators. Look at the complacency. Okay, this is one of the lowest level in the history for last 40 years. This is where the discomfort comes. Okay, if you ask me, if any market globally has highest level of vulnerability, is US. This is despite against most of the consensus that US is the best market, but it is reaching a complacency level is so low right now, which means people are so complacent out there, and hence the vulnerabilities. I'm just trying to showcase few of the data points. Last graph, and just similarly we can capture from the Reliance perspective, because something unique happened recently. Look at this is a Reliance perception graph from the Nifty point of view. This is a 2008 perception index for the Reliance on relative basis, and this is what happened in August, September. Okay, and this was 2015 was the extreme low. It was on the neglected territory. Okay, so is the case we can quantify the greed parameters. Greed indicator peaked out here in September 2020. Okay, and since then you have seen Reliance has corrected a lot. Okay, so this is another liquidity indicator. So our liquidity parameter also hit in September 2020. It was exactly the similar level. What was the liquidity parameter which was there in terms of 2008 when market peaked out in January 2008 for Reliance. Okay, so I can talk for hours on this subject. Okay, just to give you some perspective, when we talk about new age styles, okay, we try to combine as a uh, as a money manager, we try to incorporate all these data points in our analysis. Okay, that call is not taken by machine. Okay, that's a big difference from our perspective. We use machine and as a like a research assistant or support system for us. Okay, but the final calls are always taken on the money managers, because we track these data points on a relatively basis, on a live basis. So we, whenever something changes, we the way we manage our money is more for treasury perspective. The idea is to give you absolute return, try to manage money in an active way, and we have very limited constraint. We don't put too many constraints in the system. Okay, so the idea is to give you best risk adjusted return, and we use technology a lot in terms of quantifying the sentiments or the data points. Okay. Thanks a lot. If anybody has any specific question, we're happy to answer that. So somebody asked me a question about, can you elaborate sector wise? See, because time is very limited, the way I have showcased the Sensex in the exact manner we can do for sectors and we can do for stocks. So I am just trying to showcase the most largest market cap company as an example, and Sensex has a lot of history with us. Okay, so we have tried to showcase, but all the stocks, all the parameters which we backtest India, we don't backtest in India, we backtest in US. Okay, because that's the country has 120 years of history. Okay, so anything which is, because the entire thesis is based on the behavior finance, in some manner we try to quantify fear and greed. So the characteristic of human doesn't changes. Okay, it's only the intensity of fear and greed can differ from emerging market to the developed market.
Sandeep,
Yeah,
couple of interesting questions which will probably interest everybody.
yeah.
Uh, Given where valuations are in the current COVID situation, what is your near-term equity outlook? That's one. Do you have a
Okay,
medium to long-term view on any other region and asset classes?
okay.
Assets under management have been growing very fast for the AMC. Till what size can you comfortably run this high churn strategy?
Okay.
And lastly, how are the returns in the last 1 year? What was the maximum drawdown in March 20?
Okay.
Yeah.
So, as I said, Premal bhai, we try to combine these data points and then form opinion. So let me give you my larger perspective. I cannot talk for 20 years or 30 years. I can only talk right now, whatever outlook we have till 2023 based on our predictive analytics model, which we have been talking about. And we have been saying from 2019 how it's going to unfold. Okay. Our big larger thesis is that the risk appetite and liquidity parameter in developed markets are peaking out. Okay. The impact of liquidity parameter can be really felt after 6 months, 12 months, or even 15 months. Okay. And as you say that, we always try to give you example, how money shifts, from high risk to low risk environment. When we talk about, when we say, how water moves from, from mountains to valley. Similarly, when we try to do the money flow analysis, okay, the risk appetite and liquidity work very closely. We have seen from a larger perspective that money shift from high risk environment to low risk environment. We believe if I have tried to combine the risk parameter, risk appetite from global market, I'm talking about DM markets particularly, which is like US alone is 65% of these market in terms of market cap data, roughly. That segment is giving you early signs of vulnerability, which I have shown you some data points. Our sense is that whenever market peaks out use, it's a question of time. Okay, the way I look at maybe a quarter's time, maybe a month's time is very difficult to quantify. But from the purely data points, I believe US is on the fag end of peaking out. Okay. And obviously, when US market peaks out, it has its own impacts on the global equities from a near-term perspective. But when I look at the larger perspective and 2 years or 3 years or 5 year perspective, we believe the liquidity which is speaking out in US and the risk appetite, I think money will shift towards emerging market in a big way, and money will shift towards Asia in particular. Okay, there are multiple reasons which we can quantify, but just for the pause of time, I only want to highlight that the entire thesis which we are is or data points which we are indicating is talking about the outperformance of emergence of emerging market maybe for next 10-year perspective and underperformance in developed. Okay, so that's a larger thesis which we are looking at. Okay, and when we talk about emerging market, then by default commodity prices, which we are very optimistic, and we will talk about pressures and non-pressures both. Right from 2019, we have written this book being relevant. We have showcased that 2020 onwards, agri prices will start rallying, commodity prices will start rallying, and this is something which is unfolding. We talk about inflation risk and can come back from second half of 2021, which will go up to till 2028. But the pace will be slow. It's not going to have any major impact on immediate basis. That's the first point. Second thing, we talk about uh, uh, the strategy of scalability of the strategy. Okay, so I think the strategies are very scalable. Okay, this question was asked when we have 1.5 crore rupees of corpus and small cap last year when we started accepting public money. Today we have an active fund which is more than 400 crores. The returns actually in the last quarter when size has increased is one of the best in last 1 year. Okay, so I don't see we have any challenges. See, the way we look at data very closely. Strategies are always scalable. Maybe when size grows up, depending on the impact cost of the stock, we will try to readjust our portfolio, and maybe I'll start using derivative products in a big way. Okay, because the impact cost of the future and option space is on the lower side. Let's compare let's park options for time being. Maybe if I have to buy a 10 lakh share of a Reliance and I have to buy a 10 lakh, I'll prefer to buy a 10 lakh shares of Reliance in future first. Maybe in fraction of minute I will get it. Okay, or maybe a few minutes I will get that trade. So it's all about, and we ourselves understand that space quite well. We were leader in that space for a long period of time. So we understand how to optimize these available instrument in the market for the particular strategy. So I don't see any concern on the scalability aspect right now. But we, as a house, we always work on risk of environment. The moment we see a risk of environment, we prune down. Let's say example, COVID phenomena unfolded. A lot of people got worried. But what we did in our portfolio, we have not raised cash because our risk parameters and liquidity parameters have actually improved. Okay, so we have actually increased our exposure to the small cap in last 1 month, and the logic was simple: with the risk appetite marginally improved globally, and this is one of the reasons we started try to optimize on that. Okay, so our thesis is that how well we restructure our portfolio. So we prune down our portfolio from the let's say cement stock, or so we were focused on the export centric global companies, okay, and rupee depreciation centric. So we were heavily into healthcare, IT, pharma, metals, okay, and we pruned down all consumption related stock. Okay, so right from 19 February, myself and Anupam were discussing yesterday, and market peaked out. Competition has corrected on the other schemes, has corrected by 8 to 10% in the market, where we have moved up between 8 to 22%. So our outperformance is substantial in that period. So I think it's all about how well we can capture the risk on risk of environment. If we can capture it, then we don't see big challenges there.
સવારે દિવસમાં બે ત્રણ વખત જોઈ લેવાનું. આમાં કેવું છે મને પોતાના અનુભવ.
Anupam, Sandeep, can you explain your returns of last 1 year?
Just 1 minute, let me mute first because a lot of noise is there. Yeah. Yeah, Ashish, you're talking about returns?
Returns, yeah, because I think that is the ultimate thing investor wants to know.
Ashish, let me make a general statement here. And Rahul, will you correct me if I'm wrong? I think each of the three products that we have showcased today have outperformed most of the mutual funds and most of the plain vanilla portfolio management schemes in the last 1 year. Rahul?
Yeah, it is correct, sir. So they have outperformed over last one and a half year by a significant margin.
So all these three have outperformed. I think further details and actual performance can be seeked. We can always share it with you at a later whenever. But the point is, and very important point is, that each of these three products have outperformed every mutual fund and every plain vanilla portfolio management service in the last 1.5 years.
Like, just to conclude this, I think this small cap fund in last 1 year has outperformed by 100% compared to the second best.
That's correct, Ashish bhai.
Can you but it is something extraordinary. So outperformance is a very generous word. Let somebody achieve, let him give 1 minute for it. Can you Sandeep elaborate on your small cap performance?
Number as of yesterday. Just give me a second, just
Yes, I think
just uploading
something extraordinary in market. It's a
Okay.
public market we are talking
Yeah.
about.
So, so I'll give you perspective. We try to measure the performance from the bottom. So 24th December 2020, where market made a bottom, and we believe that performance of any manager should be touched from the difficult environment. So from 21st March 2020, we have delivered 268% returns. Okay. And we have outperformed the small cap index by 106%. And this performance has come with a low beta of 0.9, average beta of 0.992 levels. Okay. So in last 1 year, this is the portfolio beta, not the NAV beta. So this is a portfolio beta, which we ran our portfolio. And yes, it is. And I think what is more important is that you have to look at the risk adjusted return. Outperformance 106, 107% is very good. But what it came with a low beta. So we have taken very limited risk in delivering these numbers.
And let me add it, index is the third best performer. There's only one fund which has outperformed the index.
Yeah. Yes. In a small cap category, not a single fund apart from us has outperformed the index itself.
Yeah, that's why Premal, I said, let us all the 260 people understand what the extraordinary return can be generated from the public market. And this performance is on quarter to quarter. Let me tell you, all my colleagues and investors. We'll discuss in a later round, or we'll send the slides to all our clients. Thank you very much for performance and all.
Thanks, Sandeep.
Yeah.
If there are any further questions, we will get back to you.
Yeah.
Thank you very much for joining in.
And
Thanks a lot.
Thanks a lot, Sandeep. Thanks.
I hope you continue with us.
Yeah. Yeah. Thanks, Ashish bhai. Thanks, Premal bhai.
Okay. Thank you, Sandeep.
Yeah. Thanks. Bye-bye.
Our next product that we'd like to showcase is Upside AI. It's a fund which is run by Kanika, Aggarwal, and Nikhil Huda. It's an artificial intelligence-based fund, a different theme, and one more product which has been able to outperform every other fund in the market, which are plain vanilla. So over to you, Kanika.
Thanks, Premal. Hi, everyone. Good morning. I know we have 15 minutes for our presentation, but I think we're going to try and do this in 10 so that you guys can ask as many questions as you all have. Like Premal was mentioning, we are Upside AI. What we're trying to do is investing using artificial intelligence. We are structured as a PMS. And before we start also, I think team introductions are very important. I am Kanika, of course. I'm a CA and a CFA by training. I started my career at EY, spent some time at Credit Suisse in the investment banking team. And then I was with Mayfield doing early stage investing in startups for about 4 years before I moved on to the public side. My co-founder Nikhil is on the call. So Nikhil, if you could introduce yourself.
Yeah, hi everyone, Nikhil here. So I'm the tech side of the team. I did my bachelor's in computer science from IIT Bombay and joined Credit Suisse, where I was with their algorithmic trading department. 15 months later, I went back to IIT to do my PhD, working on optimization and design of really large distribution networks. And then the last 3 years, we have been working on this.
And our third co-founder, Atanu, again, IIT Bombay, Nikhil and Atanu studied together for JEE and got in together. He was at Credit Suisse in investment banking, and then he's been in New York for many years working with a large investment group in venture investing as well as public market investing. So that's the team, a good mix of finance and tech, I would think, to build out the products that we have been. So before we even start off, just want to talk about our numbers so that it just sets context on what we've been doing. We've been live since July 2019. So nearly 2 years we've been around. Our Upside Multi-Cap is a broad-based market fund, can invest in any, we don't have any market cap filters on it. So it ends up being a 85% mid and small cap fund. Since inception, it's done about a 60% return over the last 2 years, which is double of the index. Over the last, in 2020, it has been a top decile PMS, exactly like what, Premal and Rahul was saying. And, just like Sandeep was talking about risk, which is very important for us, we're very happy with our returns. It's done great. But more importantly, the whole idea is, can you achieve these returns at market level risk? Right. So if you look at our top right-hand box, it talks about your drawdowns, your standard deviations, and they look very similar to our benchmark. So the idea is if you put money in an ETF, a Nifty 500 ETF, you would have to take this level of risk. Your drawdowns would look like this, your standard deviation would look like this. So we're saying we're taking that level of risk, but you're able to deliver significant outperformance. So just want to sort of set context with our performance as we move forward. Right. So what are we really building, or what have we built? Right. So a lot of our inspiration came actually from Warren Buffett and Benjamin Graham. So Benjamin Graham has written The Intelligent Investor, which is almost a Bible for most value investors. And Buffett has this introduction at the beginning where what he talks about is that to be a good investor, you don't necessarily need to be very smart, right, or have some inside information or unusual insights. All you need is a sound intellectual framework and the ability to keep emotions from corroding that framework. This sounds simple enough, right? Build a framework, make sure you don't get emotional about it. But this is where most people break down, right? Because there'll usually be some exceptions. Oh, this time it's different for this reason. Or, I'm going to do, I know I decided that when it dips, I'll buy, but I'm too scared, right? Or I shouldn't sell, but I'll do it anyway. And those are the things that start affecting your returns. So for us, we said, okay, how do you keep emotion and bias out of investing? And the best way to do that was the use of technology. And, like Premal Bhai was talking right at the beginning, this is not something new. Using technology investing is very clearly the direction in which the world is going. Increasingly, there is a move away from humans into some sort of systemized rules-based investing world over. Right? Whether it's US trading activity that's moving, now majority of it is tech run, or you look at even ETFs, right? More money is now managed by ETFs and active mutual funds in the US. And your top 5 hedge funds in the world are all quants now. So you're seeing this shift, and sure, AI, ML, machine learning, all of this is just a type of technology. But the main point is that less human, more rules-based approach is really where the direction in which the world is moving. But then when you come back and you look at India, right, how we're using technology is still a little, I want to say rudimentary almost, right? Because you're doing high frequency trading, right? Konsa server, is the closest to NSE. Can you do thousands of trades a second? Or some technicals, reading price, volume, doing momentums, all of that, which is almost, I want to say solved. Most of the money that you and I are putting into the markets goes into fundamental investing, right? Where you're giving money to a human fund manager who's saying, hey, rely on my expertise, my intuition to pick the right management, pick the right industry, and pick the right company, and then deliver alpha for you, right? And the whole idea is that this is where they've been failing. And I think Premal was talking about it right at the beginning, where over the last few years, humans are finding it increasingly tougher to beat the index because markets are getting too complex and the amount of information that's flowing in is much, much harder for anyone to follow, right? So for us, we said, okay, this is what you need to be solving, how to do fundamental investing. And that's what we've ended up building. So we said, forget technicals, forget high frequency, all of that. Let's teach machines how to do fundamental investing. Read P&L, balance sheet, cash flow data, and figure out what it means to be a good stock. So, and I think, Nikhil, if you could talk to us a little bit about exactly how the products work.
Sure. So just quickly running through the overall process, right? For us, all the stocks that are listed on the NSE. So we feed in all their fundamental data. That is again publicly available, no secret source here, right? Your balance sheet, your cash flow, your P&L. But right at the beginning, we do have a liquidity filter where we throw out any company that we cannot reasonably enter and exit. So although there are about 2,500 companies listed, practically speaking, we look at the top 500 to 800 companies listed by market cap, right? And for all these raw numbers, raw financial numbers that are reported every quarter, every year, these are then converted into parameters, again, which any other human investor or analyst would look at. Nothing special here. Your growth percentages, your capital efficiency, your valuation metrics, so on, right? The third stage is really where the algorithm kicks in, where what we do is basically the algorithm comes up with some naive ideas as to what it means to be a good portfolio given the market conditions today. And then it validates that idea. It goes back in time, it tries it out. Okay, if I had picked this kind of portfolio performance move, how did the market react to those fundamentals? How did the fundamentals move? So all of those interactions are sort of captured. And then by the end of this process, it will say, okay, I had this naive idea of what is a good portfolio. Some part of it worked, some part of it didn't work. Why didn't it work? What can I do? It'll make a small change. It'll try something slightly different and then repeat the process. And this process is basically iterated again and again to the tune of 50 million times. And by the end of this process, what we have is a portfolio which the algorithm thinks this is a good solid portfolio to hold given the market conditions today. And what kind of portfolios are generated? It's about 10 to 25 stocks. Even the weights are allocated by the algorithm itself. We do not assign them. At this point, we do have a couple of risk layers in there where we say position can be 10% at cost and no can be more than 35% in cost. And beyond that, we also, for let's say 15 companies got selected, right? So for each of those,
I think you're breaking up.
Yeah, I think Nikhil's breaking up. Let me just step in. So basically, what's happening is it's essentially teaching itself, like Nikhil was saying in step 3, on what it means to be a fundamentally good portfolio right now. And then after that, it says, okay, I understand. Here's a list of 10 to 25 stocks. These are the weightages in which you need to buy these stocks. And it's not some automated buying. There's no direct orders going in. After that, we do manual corporate governance checks on everything we are buying. Now, what we are solving here is garbage in, garbage out. I don't want to take a call on whether I like steel as a sector. I just want to figure out, can I rely on JSW Steel's numbers that go into the algo, right? Because the algo is making the decision on what's a good stock. So these are checks done by us. And then after that, we place orders with the brokers and buy those portfolios for our clients. And then you rebalance every quarter as new financial numbers come. Right? So the idea of doing this is to essentially say that there is no one fixed formula of fundamental ratios that define a market, right? Or define a good company. These keep changing with time. And what the algo is supposed to do is learn the model that matters in this market. Right, so that's broadly what the tech does. And I do want to pause here and see if there are any questions before we sort of move on, because this is the meat of it. Right. So what are the parameters that define the market? So the parameters that we're using to define the market are what we're saying in step 2. Right? हम बोल रहे हैं कि कोई भी company को define करने के लिए you're looking at growth numbers, return ratios, cash flow, debt, equity, valuations. all of that, right? So when you look at a market as a grid, you're looking at each company being defined as by these 20, 30 parameters, but now expanded into all companies, right? So the market gets defined by what are the fundamentals and what are the valuations being ascribed to these fundamentals based on this. So it's a fully bottom-up approach. We don't look at macros. We don't look at, growth, liquidity, all of that. We believe that when you go bottom-up, enough information is coming in through your financials and your valuations to make a call, right? So the most important part of this is essentially to say that, listen, I don't know what the right growth number is for this market. How did we all decide that 20% growth is good and 10% growth is bad, but and 50p is too expensive? We've decided all of this together. So the whole idea is that when I say that these are the numbers for every company, I'm not saying what's the right growth number or what's the right weightage for growth in this current market. That's what the algo is figuring out. That if there are 30 parameters, what is the right number for each of them? What's the right weightage for each of them? And that's the model it's building every quarter, which keeps changing because markets keep changing. So what you buy in March 2020 versus what you buy in December 2020 should look very different because markets have changed and they've started valuing different things. Right? And then there was another question. Do you do only PMS? Yes, that's the only product we have at the moment. PMS, it's a minimum 50 lakh product. No other products are available. When there is a growth of more than 10% in any stock, should we get out without waiting for the end of the quarter? Nikhil, do you want to take this? I hope your internet's back.
Yeah. It's is it better?
Yes, it's better.
Yeah. So no. So the short answer is no. We do not exit. And then the flip side, we don't exit when the stock goes down either. Because the whole point is, again, when do we know 10% is good enough, right? We have currently in our portfolio stocks that we bought a month ago that are up 30-40%. Now tomorrow, do we know will they go further up or will they go down? We can't make that call as humans. And we have backtested our numbers all the way from 2007. And we have tried different techniques, what if we exit at 20%, 30% and so on. And in general, we found we always underperform when we do that. Let the machine make the decision. And our decision really comes when the fundamental numbers change. So when the quarterly numbers are reported, that is when we want to relook at our decision and rebalance our portfolio, not before then. Which tool you use for arriving at your decision? The entire tool, the entire software is being built by us in-house completely. It's completely proprietary. We don't use any sort of third-party tools. The only thing we use are the third-party data feeds, which are databases and Reuters and stuff like that. But once the data is in, everything else is done by us.
Right. So another question.
Kanika, one last question.
Yeah.
What is the most important factor to consider? No, sorry. Do you ever have a view on broad equity markets? Would you be fully invested irrespective of straight market valuations?
Right. So the answer is we try not to take a view on where the markets are going to go. The whole idea of using machine learning is that in every market, there is a $100 bill available for $80, right? You're supposed to find that. So the algo is sensitive to the price at which it's buying things. So in all markets, it's trying to figure out, okay, where is that value arbitrage that exists for me? And that's the kind of decisions it's trying to make. So for us, the call we know is that in the long term, markets trend up, not down, right? 5 years later, your markets will probably be at a higher level than they are today. So I don't care what happens in the next quarter or in the next 6 months. I just want to every quarter pick consistently good stocks, which can do slightly better than the index. That's the only mandate that I'm giving the algo to do. Just pick slight stocks that can do a little better. And then all of that is what compounds, right? So for example, just want to talk about our backtest. We've talked about our live numbers, but even before we started, we had about 12 years of backtest data from 2007 to 19. And what we tried to do was check how we would do against the best 5 mutual funds over that period, right? Because I'm saying I'll do better than a human because I don't have biases. So can I really do that, right? So if you look at the left-hand side graph, the blue line is us. The yellow line is an index of the best 5 mutual funds over that period, and the gray line is the index. So of course, we're able to beat it 3 times over, right? We have a 25% CAGR. This is net of all fees, transaction costs, everything. Mutual funds do 14%, and Nifty 500 does 10%. But all of this is fine. But when you go to the right-hand side chart, right, this is quarter-on-quarter movement of all 3 of us. How do we move? And if you actually look at this graph, you'll see that all of us more or less move in tandem. सब ऊपर साथ में जाते हैं, नीचे साथ में आता है, right? And that gives us a lot of comfort, because usually people are scared with tech to say, okay, oh, it's an algo, there'll be a flash crash, it'll do something funny, you don't know how it'll behave. So for us, we're very happy that it behaves exactly like it's supposed to. At the end of the day, while we're using all of this machine learning, it's a pretty boring product, right? All I'm saying is I'm going to use machine learning to figure out what are good 15 stocks to buy this quarter, buy it, hold it, and forget about it, right? Nothing else. And I'm hoping they're good stocks. So if you look at us every quarter, you're just trying to do slightly better. There are these small bumps of alpha, and that's what compounds into a dominant, outperformance. And that's really what the promise of the algo is. So no calls on, short-term views on markets. That the algo does take, cash positions if it doesn't find enough opportunities to buy. But other than that, we don't try and predict where it's going to go.
Yeah, Kanika, this is Ramana here.
Yeah.
Kanika, this is Ramana here.
Yes, hi, Ramana.
Your portfolio predominantly seems to be small cap, but you still manage the risk. How do you manage that risk?
Right. Nikhil, you want to take this? Right. So I think in this, yeah. So let's just talk about that for a second, right? So while we're, and this is very important, we bought 70-80% mid and small caps, and in March when the markets fell 38%, that's the max drawdown number, live markets, this is Corona numbers, right? We fell 35%. And this is very consistent with our back tests where I'm showing you what happens in say a 2008 or a 2013 when markets fall, we fall roughly the same amount. And the whole point is, that's the whole point of using machines, which is to say, pick good stocks which limit your downside to the market. So to us, our betas are about 0.8 and consistently over long periods of time. And our standard deviations and drawdowns are very similar to market over very long periods of time. So if you're going to invest in the product, you should expect when markets fall, we will also fall similar to the market and go up faster.
Okay, basically what you're saying is it's inbuilt into the model.
Yes, exactly.
Right. I think what Ramana was asking was how is the risk sort of managed, even though there's so many small caps? And that's the whole point, right? We want to pick good, solid companies. We're not sort of randomly picking small caps, which are, could be more volatile. That's part of the process, basically. To pick and it's a portfolio level approach to pick a good, solid portfolio that will give you better risk-adjusted numbers, not just returns.
All right, Kanika, thanks a lot for this presentation.
And as our partners were saying, Premal and then Ashish, we do test these products before actually we come to the clients to suggest these funds. And for last 1.5 years, we have invested our proprietary money into this, and then we found it to be exactly to the way what they are describing it. It's a very dynamic portfolio. Every quarter it changes, but very well risk managed, and then giving a very good alpha over the benchmark. That has been our experience, and team is very agile and then do a good job. Thank you, Kanika.
Thanks, Ramana. Thanks, Premal. Thanks everyone for your time.
Yeah, I'd like to introduce Harjeet Singh of Stelios. Hi, Harjeet.
Hi, Premal. Hi.
And Harjeet
Can you hear me?
Yeah. Harjeet runs Stelios Global, a long short strategy, which is very, very, not really caught on in India in a big way, but I think he'll give you an idea. Harjeet, I'd like you to explain what exactly is long short before moving to your fund objectives and performance.
Sure. Thanks, Premal. I'd like to get started. So very good point, Premal. What is long short? A long short essentially is, trying to hedge out your portfolio, or trying to take advantage of bearish market movements whenever markets crash. So can you hedge yourself? Can you hedge your portfolios? Or in fact, even better, can you take advantage of bearish movements like the ones we saw in February and March in 2020? Is all about what long short is. There are different kinds of long short funds and products in the market. India is relatively new to the long short arena. Long short is something which is fairly popular in countries like US and outside And it's a trend which is catching up in India, but still a lot of ground to cover. There are 4 to 5, AIF funds which are positioned as long-short funds, but unfortunately, the way they manage money is very different from what a typical long-short fund would do. Suppose a US-based long-short fund, which you talk about. So long-short funds typically are very dynamic in nature. They try to change their positions or allocations to the market very quickly. They are very nimble. Suppose next week you're sitting on 70% net long. Maybe next month you could be sitting on a 30% net short on your fund. And this is how long short funds work. They try to take advantage of the market regime which is currently going on. In bullish market regime, the portfolios are more tuned towards net long sides, and in bearish market regimes, the portfolios are more towards the net short side. So that's exactly what we also follow. The flow of presentation, I would like to keep it very brief, although I have a lot of slides and a lot to talk to, but I'll try to be as concise as possible. This is the flow of things which is going to transpire. We'll start with the introduction. We'll talk about hedge fund objectives, our hedge fund objectives. We're going to talk about performance to set a context of us versus the rest. Then we're going to talk about the most important point, which is how do our algorithms interplay and how do we actually, make alpha in the markets? Because as you all know, there are various ways of making alpha. And then finally, the interplay of these algorithms, how do the dynamic long-short allocations work? So I have a very simple example to take you through with that. Let's get started with our introduction. Stelios Asset Management is a global asset management company. In phase 1, we have launched and instituted 4 hedge funds across the world. There is an India onshore fund in the form of an AIF Cat 3 SEBI registered. Parallelly, for international clients, we have 3 offshore funds, 1 India-focused offshore fund in the form of an FPI Cat 1 out of Mauritius, and 2 DIFC, which is Dubai-based DFSA-registered hedge funds, 1 global and the other GCC-focused offshore hedge funds, which are primarily. So we have 4 vehicles where money is managed 100% through automated algorithms, where right from the trading or investment decision right up to the order hitting the exchange, everything is fully automated. Everything is non-discretionary, which means right from basket creation to the market timing on those basket creations, all these decisions are taken through algorithms. We are a quantitative-based hedge fund, collection of hedge funds, which means that we imply a lot of quantitative styling and machine learning, to be precise, when we form investment as well as trading portfolios and take decisions on them. One more thing which I wanted to point out was our fund. Essentially, all these funds have been seeded by an international venture capital fund based out of DIFC, which is backed by a multi-family office out of Middle East. So very strong backing for a group. Across these various funds, we have managed to raise commitments of around $30 million so far across various funds. So this is where we are in terms of various hedge fund vehicles. This is a snapshot of the AIF Cat 3. I will not be able to explain everything, but most importantly, we have Vistra as a trustee, prime brokers being Phillip Capital and Edelweiss, the custodian and the fund accountant being Kotak Mahindra Bank, and the auditor being PwC. Our management fee vary from 0.75 to 2%. We follow performance fee model as well, where 20% of the performance will be shared by the investment manager and the rest obviously for the client. And there are some other details which probably we'll take it up later. But primary assets traded, we focus on both segments, the cash market segment, which is equities, as well as equity derivatives. Our universe in the Indian fund is NSE 200. So we focus on the top 200 names as far as liquidity is concerned and as far as market cap is concerned. So what is our philosophy of? As I mentioned, we are a fully automated, non-discretionary trading hedge fund. We are a multi-styled hedge fund, which means we do not depend on a single algorithm. We deploy a collection of more than 10 different algorithms, which include the likes of machine learning, fundamental factor models, and other hedge fund style algorithms, which I will talk about very soon. We are non-discretionary, which means all decisions are taken by algorithms and it's fully automated. The other USP of what we do is we do a lot of dynamic asset allocation, which means we follow an active management style. This style is focused more on generating short-term alpha through micro market moves. For instance, I'll give you an example. If suppose the first week of June is downtrending for the markets, and say the next subsequent week for the markets is uptrending, we try to participate in each of those micro movements. So for instance, if the market keeps falling for 5%, you have a micro move of 5%, or panning out over the next 2 weeks, we try to take advantage, and we try to, as far as possible, capture the price trajectory, because that's where the alpha is generated, by capturing the price trajectory, at the same time trying to keep the drawdowns at a bare minimum level. The third USP is it's highly diversified across trading strategies and assets, which means we deploy diversified algorithms and styles where we try to achieve lower correlations with respect to benchmarks, and where there's sufficient diversification on various stocks and sectors. We would like to talk about our management team. I'm the key person on this initiative, acting as the global CEO and CIO. I'm basically a financial mathematician from Stanford University, holding various important charters. I have worked in various top investment banks like Nomura, Merrill Lynch, Morgan Stanley, across Wall Street, London, and Amsterdam, and Mumbai. And I've worked on various investment management, treasury, and quant trading desks. I'm also consultant to the Department of Economic Affairs, specializing in algorithms and in financial markets frameworks. The other two, management persons in our team, one is Mohammed Al Gait. He's a resident of Middle East, specifically Saudi Arabia. He's also the CEO of Al Arabi Investments, which is the VC fund which has seeded us to help us with the capex, opex, as well as meeting the sponsor capital requirements on every hedge fund vehicle. He's worked as a mutual fund specialist and has handled mutual funds for a lot of years out of Saudi Arabia. The other person is Rohit Nerurkar, who's also the board member, and he has been an investment banker and a venture capital expert for the last 20 years, and currently he's advising the Royal Court of Saudi Arabia on various venture capital ventures. In terms of fund analysts who are part of our team, we have a very small team because it's a quantitative driven hedge fund. We have a team of around 10 odd people, out of which we have fund analysts who are have very strong pedigrees and are very bright kids from the likes of Oxford University, IIT Hyderabad, IIM Ahmedabad. So this is a bit about our team. Coming to our hedge fund objectives very quickly. Kind of styles, hedge fund styles, which we follow is fairly revolutionary as far as India is concerned. And I will talk about it very soon. But the kind of favorable investment outcomes which we try to target is, those 5 boxes at the bottom, where we try to target lower drawdowns, consistent returns across various kinds of market regimes, lower correlation versus long-only benchmarks, lower systematic risk, and smaller loss tails whenever losses happen. So we can't give reasons to our clients that, look, Nifty is down 30% over the last 2 months, and hence I'm probably down 20% on my fund. We can't give reasons like this because it's an absolute return vehicle, which means the whole objective is to have consistent returns, be it a bearish, bullish, or a low vol or a high vol market regime. We tend to try to outperform in various kinds of market regime. There are several algorithms, and hence it's a multi-style fund so that we capture most of the market regimes which pan out. Let's quickly go and let's talk about what differentiates us. So what differentiates us? So we've kind of done an exercise of us versus other hedge funds in the Indian market, as well as far as other mutual funds are concerned. So as you can see, the table at the bottom, we have equity upside participation. So whenever markets go up, we are participating in that. And in fact, we optimally utilize the 2x leverage which SEBI allows us, which means in uptrending markets, we try to outperform the benchmarks because we optimally try to leverage ourselves between 1x and 2x, which is the optimal space to be in. Our fund also provides downside protection in bear markets. And not only protection, we also try to take advantage in bear market movements, because most of our trades in bear markets are on the derivative space, which is futures and options, where we either short futures or employ complex option trading strategies, which take advantage of bearish market movements. We are highly active managed house. On an average, the average trade period or holding period on the derivative side is around a week for us. And on the cash market segment is around 2 to 3 weeks for us. So as you can see, we're a fairly dynamic, actively traded fund, purely from a perspective of gaining absolute returns, higher absolute returns versus the peers and versus the benchmarks. As I already mentioned, we use leverage to our advantage. We are totally algorithmic and automated driven. So not only employing algorithms for achieving non-discretionary decision making, but also this algorithmic process is fully automated. We're a multi-strategy, multi-styled hedge fund. And the investor manager orientation is towards absolute returns, irrespective of whether markets are rising or falling. We do not care about that. What we stand for in terms of styling, as you can see here, we are more veered towards the quantitative styling. Our Sharpe ratios are towards the higher side. We generally are sitting on Sharpe ratios of 2.5 or 3. In 2020, we achieved a Sharpe ratio of 3.4 upwards. Our alpha is extremely high versus the passive benchmarks. Our type of management, as I've already spoken, is highly active. We kind of take advantage of leverage, but we are not highly leveraged. At the same time, our maximum leverage, which is in the fund, is about 2x. SEBI does not allow higher leverage, and we feel that to maintain drawdowns to a certain level, your leverage in the portfolio should not exceed 2x. The holding period is not as low as what you would expect in HFT form, but at the same time, as I pointed out, on the derivative side, our average holding period is about a week. On the cash market side, approximately 2 or 3 weeks. It's fully algorithmic driven, as I've already mentioned. Let's talk about performance. How did we do in 2020? Before I get into how did we, manage that level of performance. We started our prop books in January 2020. From January 2020 till March 2021, we have a return of 100.1% across a year and 1 quarter, which is amongst the top decile performances in the industry. If you look at Nifty 50 benchmark since 2020, Nifty has been up 24%. We have outperformed the Nifty by nearly 76%. So huge alpha with respect to the passive index. Further, if you break down the performance, if you see the bear market performance versus the bull market, the bear market is in red, the bull market is in green. The bear market, which ensued in February, March, as you can see, we had extremely low drawdowns. Our performance is in blue. The market is in red, as you can see. Through February, March, as you can see, Nifty fell from the peak to trough drawdown was nearly 38%. And our drawdown, intra-month drawdown in those 2 months was barely 3.5 to 4%. So we managed our drawdowns very well in a very challenging market environment. And we are a hedge fund which does extremely well, not only in the bearish markets, but also in bullish markets. There are a lot of international hedge funds which do extremely well in bearish markets, but not so well in the bullish markets. We are a hedge fund. Since we deploy multiple styles, we are able to outperform in various kinds of market regimes. So as you can see, the distance between the two curves keeps on increasing, which means we've been able to generate consistent outperformance across the bullish market regimes as well. If you were to ask me what is a month-on-month performance, this is the table which gives you the month-on-month performance. In fact, what is interesting to note is that from January to March, when Nifty was down nearly 30% and mid-cap was down by nearly 40% peak to trough, we were up 14% from January to March. And this was because of most of the positioning in February and March, which was taken was on the net short side of the market. In fact, by the end of February, we were sitting on 75% net short on our books, and which is what explains the heavy outperformance in the month of March. So whenever there's a huge fall in the markets, we actually take advantage of that, and we are in the heavy positive territory. And as you can see from June onwards, which was the onset of a proper bull market, we have not only performed well, in absolute terms, but we have kind of outperformed Nifty in most of the occasions. In fact, when Nifty was negative in 2 months, September and January, we were actually in the positive territory in those months, which again says that the whole purpose behind these hedge funds, the whole philosophy is absolute returns. And what we've done is we have also, on the last column, as you can see, we've also benchmarked ourselves against the Eureka Hedge India Long Short Index. And as you can see, that long short index, which is for AIF industry in India, CAT3 funds, that index itself was 12% negative by the end of March. On the other hand, we were 14% positive. So that also shows that we are very different from other long short AIF funds in India. And that is what really sets us apart. How did we perform on the risk basis? We had extremely low correlation since the start of our performance. On Nifty, we have a negative correlation. With midcap, we have a negative correlation, which means when these indices fall, we actually make money, which is great, which is what is the hallmark of a good hedge fund. Our correlation with the India hedge fund index is approximately 0.22. So as you can see, it's fairly low correlated versus benchmarks. The maximum intra-month drawdown from any peak to trough. Please note, this is not from the initial capital. This is from any peak to any trough. Was maximum 8% for our fund versus Nifty 50, which was 38%, mid-cap 45%, and the hedge fund index, India hedge fund index, which was 22%. So as you can see, our USP is that we manage drawdowns very well. Our drawdowns are not that much, even when the market regimes are not suiting our algorithms. We managed a Sharpe ratio of 3.8 since the start of our trading. And as you can see, it's heavily outperformed the other passive benchmarks, as well as the India hedge fund long short index. This is the chart of drawdowns. As you can see, in February, March 2020, the maximum drawdown which we had was around 8%. Compared that to the Nifty, which had a drawdown of around 40-odd%. And please note, this is not drawdown from the initial capital. This is drawdown from any peak to any trough. This is our back-tested performance from 2010. On our fund, we target absolute returns to a tune of around 25 to 30% on an average annualized basis. Our backtesting has given a performance of around 34-odd%. In the same period, Nifty has returned around 10%. So our backtesting has given 24-odd%. And in the live market scenarios from 2020, we've been able to generate an alpha of nearly 76% with respect to the Nifty. And in fact, if you see the backtesting also, we have done fairly well in bear market regimes. 2011 was a case in point where there was a Eurozone crisis. Our fund would have been up 50-odd%, where the Nifty itself would have fallen 25-odd%, fell 25-odd%. 2015 was the China commodities market sell-off. Nifty was not that bad, 4% negative, but we would have been 33-odd%. 2018 was the NBFC crisis, mid-cap collapse. Mid-cap index was 25% down that year. We would have been 48% positive versus the Nifty at 3%. Most important part, how do our algorithms interplay and how do these work? I would just like to take a couple of more minutes on this. As I pointed out, it's a multi-styled fund where we deploy multiple strategies across the entire gamut, which is NSE 200, which is our universe. And the whole purpose of doing that, of running multiple strategies, is to not only diversify across sectors, across stocks, but also across strategies. Because there's no one strategy which keeps doing well all the time in the market. One strategy which is written, an algo strategy, could always underperform the market, right? So hence the importance of having a diversified pool of algorithms which try to capture as much as possible the alpha in the markets. If you talk about what are our primary hedge fund styles, we follow two primary styles. The first one being managed futures and the second one being equity long short. Managed futures is taking advantage of directional market movements, both on the bullish and bearish side of the market. Equity long short is, going in with a hedged portfolio and trying to position yourself in a way which, takes advantage of fundamentally superior stocks versus fundamentally bad stocks. And then we have secondary styles which support our basket creations. We have relative value, we have opportunistic, we have dynamic short, and we have quantitative styles. These are the various alpha drivers which we capture through our various algorithms. Our algorithms are on the rows, our alpha drivers are on the columns. So as you can see, our source of alpha generation is plenty in the markets, right? And each fund manager to his own have various ways of making money in the markets. What we do is we try to absorb as far as possible whatever are the different alpha drivers through our set of algorithms which we deploy, and we cover earnings, valuation, market timing, quantitative, technical, and behavioral as some of the important categories of alpha drivers which derive our performance. If you look at our primary two hedge fund styles, managed futures and long short equity, historically those have been negatively correlated versus the benchmarks, and this is where we try to contain our drawdowns. Our value at risk is almost 1/4 with respect to long only benchmarks, and the reason behind that is the extremely low correlation, in fact in the negative territories of our primary styles versus the index. How does automation work? We outsource an exchange feed which flows into our database server. We also have our application server which hosts our algorithms, and those algorithms will automatically generate buy and sell signals, generate the trading baskets or investment baskets, and send the orders on an automated in an automated fashion to the broker or to the exchanges. So it's fully automated, as you can see. This is the most important slide, which talks about how do we actually manage to outperform peers and outperform the markets. We have a 3-step process with respect to how our funds work. In step one deals with basket creations. There we have three types of algorithms which we run. One called as relative value, which is nothing but fundamental factor models, where we have a collection of 50 different fundamental microeconomic, macroeconomic variables which we track across the entire gamut of sectors. We score stocks across sector, we rank them, and accordingly create baskets which are long only baskets consisting of fundamentally most superior stocks. Then we also form short only baskets, which are fundamentally the weakest stocks, which fall the most when the markets fall. And then we have baskets which are fairly neutral as far as fundamentals is concerned. We call that as a long short basket. So 3 types of baskets are created at the end of step 1, and we employ proprietary built fundamental factor models to do that. Step 2 is to understand what is the current market regime. So if we talk about where are we in this week or in the last 2 weeks, it's called trying to understand what is the current micro market regime we are sitting in, and that's where the machine learning part comes into the picture. We have machine learning algorithms which help understand what kind of market regime are we sitting in. Are we sitting in a bullish, bearish, and also within bullish or bearish, we have 5 micro states. So we kind of supply more than 2,500 stock prices, volatility, fundamental parameters. So it's a huge model where we supply more than 10,000 variables into that model to help us understand the broader market regime and to bifurcate that broader market regime into 10 hidden states of the market. Step 3 is once we have identified the basket, once we've identified the market regime, step 3 is to employ market timing algorithms, basically managed futures algorithms, which help us understand when to enter and when to exit a long or a short position on the individual baskets. So that's the market timing part. For instance, even if I have reliance on my fundamentally long basket, it does not mean that I will buy Reliance on day one. I'm probably going to wait for a certain correction on Reliance to happen and only then enter into Reliance. Right, so that's called as market timing, and step 3 is market timing. So our sources of alpha generation are 3 in nature. Step 1, basket creation. Step 2 is machine learning, which is trying to understand the broader market regime and trying to bifurcate the states of the market in 10 micro states. And step 3 is employing market timing over these algorithms. Do we have more time, Premal, or I've run out of time now?
I think there are a couple of questions and one observation that I'd like to make.
Sure.
I think there is a question which says that, is there a possibility of you going to negative 100% net short? And what is the highest net short position you have taken till now?
Sure, that's a very good question. I have a slide to illustrate that. So as you can see, this slide is very informative. It tells us how did our long short allocations moved in 2020. If you see the top table, algo baskets 1 to 4 are long only algorithms. which means we only do the cash market there. Algo baskets 5 and 6 are through derivatives, and we take bearish positions through algo baskets 5 and 6. If you see what happened in the months of February and March, typically February, look at the February column, we were running only 12% long in our cash market books, which means we had liquidated 88% of our cash market portfolio by the end of February. And we were sitting on through derivatives at a short position of 85%. And the net short by the end of February was 73 odd percent. In March, sometime in the first week of March, we were sitting at a net short of 85%. That's the maximum we went to in March 2020. And that heavy short positioning, as you can see, helped us outperform in the month of March. So as you can see, the last bottommost table, which is performance, when Nifty and Midcap were falling by 23, 33% respectively, our fund was up 16% in the month of March. So as you can see, heavy outperformance was because of tuning more towards the net short side. By the end of March, since most of the short bearish play was played out in the markets, as you can see, the effective net short on our books by the end of March was only 19% versus February, which was at 73 odd percent, which means we do a very good job in terms of trying to capture what is the current market regime of the broader market and trying to position our algorithms in such a way that we capture most of the price trajectory which happens. Again, a very simple example: stock goes from 100 to 200 and back to 100, in a matter of 2 months. The long only fund manager does not gain anything because the stock has come back to 100. But on our fund, we would try to capture 50-60% of the up move and 50-60% of the down move from 100 to 200 and back from 200 to 100. And that's where the alpha generation happens.
Yeah, Harjeet, basically what you're saying is entire decision making is driven by the algos, right?
100%.
Okay, so can I just summarize the style and the thing, because it's different than what the conventional products are there. Generally, yes, the Indian markets have seen only the long only products.
Correct.
Right. So this your product from Stelios, what you're saying is it actually has a lesser market risk and lesser correlation to the markets, but at the same time targeting at absolute return, which is generally more than the market returns. What is coming?
Absolutely. I mean, if you look at January to March 2020, clearly, we have outperformed the indices in all those 3 months. In March, when there was a big drawdown, even in February for that matter, we were flat on the markets when Nifty and Midcap had started falling. And in March, when Nifty and Midcap were, down by quite a bit, that's an ideal scenario for a hedge fund like us, where we gain maximum alpha. So we gained an alpha of 40 to 50% on the various benchmarks, where we were in absolute terms, we were 16% positive in March. And even if you look at the bull market scenarios, which is the green section of the table from June onwards all the way till November.
Yeah, we
as you can see,
those numbers.
There is a fair amount of outperformance in various months. For instance, even in August, for that matter, Nifty was 7% up. We were around 10.6% up. In September, Nifty was a bit down. We were flat on that in that month. October, November, again there's an outperformance with respect to the Nifty. So yeah, but Harjeet, in bull market scenarios, we try to outperform.
Harjeet, for all these things, actually, it appears to be like a no-brainer. But what do you see as a quant person? What do you see the major risk for the entire model not to work in the way what we are projecting it to be?
See, that's a very good question, and that's precisely what I pointed out. We don't rely on one algorithm, like a bullish market regime algorithm or a bearish market regime algorithm. We have 10 different algorithms, and we follow 2 primary styles and 3 secondary styles, which help us gain the alpha in the markets and help us capture most of the market regimes. So for instance, if it's a bear market scenario, probably out of our 10 algorithms, 7 algorithms will do very well and 3 won't do so well.
So basically what you're saying is all the algos what you created, set of algos, yes, itself is a risk management what you have built into the system.
Absolutely. That itself is a risk management, and also as a risk management principle, we have a stop loss, dynamic stop loss for every trade that we put. No trade is without a stop loss. The second is we have the concentration risk, which is very well managed. No sector more than 25%, no stock more than 8% weightage on our fund. And the third and the important thing is we manage correlations very well. Our correlations are, on very low or in fact even negative, as we saw last year with respect to the benchmarks.
Right, Harjeet. I think it's a very good presentation, and then I think you have driven home the concept of actually the long shot as such. So we thank you very much. We thank all the panelists, Sandeep and then Kanika and then team for being with us and then taking all the questions also. Yeah, Premal, you want to conclude?
Just one last observation, and to end on a very light mode. Somebody who said today, he made a comment, very complex fund. I won't say for whom, could be for all three of you all. Very complex fund. We come to wealth first to help, for help, because you keep things simple. So that's an observation from one of our clients.
Okay. Yeah, thank you. Thank you, everyone, all the participants. I hope it helped. Yeah, go ahead, Premal.
Harjeet, thanks a lot.
Thank you, Premal. Thank you
Kanika,
for the opportunity.
Thanks for your time.
And Sandeep, I'm sure your presentation was very informative, and we hope you three the best of luck.
I have a last question for Harjeet, if that's possible, and it will be a very quick one.
Sure.
Harjeet, is your AIF structured as a trust or an LLP?
It's a trust.
Okay, so why not structured as an LLP, which has got more effective tax structure than trust? Because your competitor, who is also leaning into long short, is recently moving towards LLP structure from June or July. I won't take the name, but just asking you, because LLP is taxed max at the rate of 35%, whereas if you're structuring it as a trust, it gets taxed at 43%. And you can induct your investors as a passive partners rather than trustees. So as a beneficiaries, that's what my question is. And these returns, I am guessing, are pre-tax, right?
This is pre-tax, correct?
Okay. So can you just elaborate on it?
That's a very good point, actually, and we were in fact ourselves mulling should we move towards an LLP structure, primarily to take a bit of advantage on the tax side. I mean, the primary reason is, see, our funds are open-ended funds, and I think from my understanding, in an LLP structure, it becomes slightly difficult to maneuver around that aspect. And hence, with respect to most of the industry participants, as you know, most of the AIF Cat 3 are trusts, and that's how we
90% are registered as a trust. But even now SEBI is allowing, they have set with SEBI, and they allowed even that one is also an open-ended, and SEBI is allowing now LLP structures. It is within the law, within the law framework, SEBI guidelines as well. So you can look into that if that's possible, and maybe you can increase the post-tax returns for the partners and investors.
Sure. That's a very good point, and we'll definitely go back to our blackboard, and we shall do our homework again on that.
Yeah. Because your fund and Sharp is very impressive.
Yes.
Sharp of 4 is like unbeatable and unprecedented in hedge fund industry.
Thank you so much.
Thanks,
all right.
Harjeet.
Thank you.
And thanks to the three of you once again, and goodbye everybody. Thanks for joining in, and our endeavor will be to keep coming out with such informative seminars in the future.